videos in our series, How Options Work. We discussed intrinsic versus extrinsic value. We discussed overall what to look for before placing an options trade. We discussed the differences between out of the money, in the money, and at the money options. And then we went overall a basic kind of how the options model and options pricing works. So in this video, we're going to discuss the actual bid and the ask before we're placing an options trade and how that affects our options trade. So we're got our Amazon stock open in here. We're looking at the March monthlies. This column right here is going to be the bid. Now, this is going to be the highest price that that the buyers are willing to pay for this option. So all these strikes right here, here's your column. This is the price everybody's willing to pay for those correlated strike price. Likewise, this ask column here, this is the highest price that these people are willing to sell that certain strike price at that correlates with that column, right? So if you look at your 2075 strike prices here in Amazon, you can see that there's actually a dollar difference between this $9 and $10 right here. So that between the bid and the ask, it's going to be 9 and 10, which is $1. So everybody is willing to purchase this for $9 and everybody's trying to sell it for 10. So that is a large gap in there that we need to be aware of before we actually go in to buy or sell this. Now, that is called the bid-ask spread. So whenever you're getting ready to purchase an option, or if somebody purchased something, you can always ask, hey, what strike, what bid at, what's the spread on those, right? Somebody say, what's the spread? Well, you got dollar wide markets, you got 50-cent wide markets, all that. That's what that means in there, is the difference between what somebody is willing to pay for it and what somebody is trying to sell it for. Now, this correlates this spread to volume and open interest usually, right? So if you see down here, you got pretty wide spreads between your bid and your ask, which is because you got low volume, low open interest. But the more volume and more interest you get in, the tighter everything gets, right? So now you got 40 cents, you got 30 cents, or $1.30 right here. This is $1.40 right here. So it usually correlates with the volume. It kind of just all depends on what people are willing to pay for it. You can see right here, you got large open interest, but low volume. And then you got a $3 spread, right? So when your open interest and your volume is kind of close, that's when you're gonna get pretty tight markets. So overall, you kind of want a 20 cents or less market for your options, because now you know you're not going to get ripped off, right? Unless you're just trying to purchase something as quickly as possible. So a good way to actually go in and purchase a call or purchase a put is going to be using a limit order. So if I was to click on here, this has a limit order on it, right? And it's actually unlocked. But if I type in something in here, I can see our mid price is going to be 950. If I type in this 950, well, all of a sudden this order limit's locked. It will not actually purchase this option for me until the option price hits 950. If I were to keep that unlocked, and I just click here again, it's going to fill me at the best price possible for me, right? So it's never going to try to rip you off on purpose. It's just going to get you at the next available price, and you don't care if it's between 950 or 10. If you're going to go in and try to do some sort of market order, it's just going to fill you at whatever, right? So even if it's above 10, whatever, it's just going to fill you at the next fastest one. So if you want to go in and try to save yourself some money, it's always good to look at your spread. Hey, I got a dollar wide spread in here. Do I want this stock right, or do I want this option right now? Well, no, it's got relatively low volume open interest. Maybe I'll move up to something else. Actually, I'll move to these 210s. And then guess what? I don't want to pay I don't want to pay $7.95 for it. The mid price is $7.25. I'm going to go here and I'm going to put $7.15. So actually, if I do get filled on this, and that's going to be, I mean, if you have to wait maybe an extra minute or a minute or two, or volatility goes down, you get a pullback, something like that, your price of your option is going to decrease because it's sensitive to all those things, right? And you could actually get filled at a better price, $7.15, rather than the $7.95. So that's always good to kind of be aware of before actually placing an options trade. And it actually affects your trading, because now you're saving yourself 10 cents, 20 cents, which equals about $10, $20 here or there. And if your spreads are super wide, you could save yourself up to like $50 to $100, right? Depending on what you're trying to buy. And it's always good because as you're waiting to get filled, it also gives you more time to kind of, okay, do I really want to buy this? Is this actually moving in the direction that I want? It kind of gives you a little breather, you know what I mean? Rather than just going in here, if somebody says slap the ask, that just means that you're doing market orders up here and you're just purchasing it at the highest price possible because you're trying to get it so quickly, correct? So that's what that is when you say slap the ask. So instead of just slapping the ask up here and buying it at whatever, you're actually putting a market order in here. You're getting covered at a better price just in case a stock kind of goes away from you. You can get it for cheaper. You're saving yourself some money. And you kind of gives you time to kind of rethink everything's too, right? So that's always good to a good tool to use as far as trying to place an options order. But again, on the put side, you have the bid and the ask, same exact thing that works on the call side. If you're trying to sell something, it's the same as trying to purchase something, just the opposite, right? So if I'm trying to sell something, I want to look at mid price. I want to get filled for the highest credit possible. And when I'm trying to buy something, I want to get paid at the lowest debit possible. So it's just kind of the exact opposite, but it's always good to be aware of the difference between the bid and the ask and the markets just overall in general. Make sure that you have some tight open interest and volume so you can get in and out easily. That's also going to help you in the long run as well when you're placing these options trades. So hopefully that video kind of helped a little bit as far as what the bid means, what the ask means, how they work together, and how we can take advantage of it in our trading. All right, guys, if you like this video, make sure to check us out on all social media. We also have a Discord server if you are interested, and you can find all of our socials in the description below.